Hey everybody, Derek Ruiz here with eXp Realty Commercial. I'm super excited today to be interviewing Saul Murray, who is a senior client advisor for CSSI, a cost segregation company. We are going to go deep into cost segregation, what it is, how it can help apartment owners and buyers and sellers. So, Saul, welcome. Glad you're here and excited to hear your information.
Awesome, Derek. I appreciate you bringing me on here. It's always a pleasure to talk about cost segregation, how this can help. Lately, with the big beautiful bill, it's out there more than ever. Everybody's heard about the bonus depreciation, 100% bonus depreciation, and that's kind of where it comes from. So the cost segregation correctly identifies everything that can then be bonus depreciated. But I put a little PowerPoint here together.
Yeah,
If
let's
you'll
do it.
allow, I'll share that, and we can go from there. And at the end, you can ask me a couple questions. And we can talk forever, and a lot of questions will stem out of this conversation that you might think of later. So I'm always easy to be reached by that email. And let's get you guys here. So cost segregation and bonus depreciation, tax savings for real estate investors. Uh, like Derek introduced me, my name is Saul Murray. I'm a senior client advisor with CSSI. We are the leading provider in the country. We've been around for 23 years now, and done more studies than any other provider in the country. We are independent. It's the only thing we do. We focus on that. It's somewhat of a requirement by the IRS to have a third-party independent provider come in and assist you in your CPA. But the way I like to talk about cost segregation is talking about 1031 exchanges, because everybody knows what that is. You do that 1031 exchange when you sell a property that you've owned. You want to avoid those capital gains, so you 1031 into another property. Cost segregation is like the lesser known cousin. It's something that you do when you buy that property while you own that property, because the cost segregation benefits are going to allow you to not pay any income tax on that cash flow that that property is generating, and sometimes income tax on other income that you might have that goes beyond that property, because the power of this cost segregation study can be so big. But the end goal for all these strategies is to maximize the money that you keep, so you can pay less income taxes and invest and buy more properties. And that's kind of where CSSI comes in. So under the current tax law, when you buy a property, let's say you buy $1 million multifamily property, your CPA is going to take a look at it, allocate some value to land, maybe 20%, and the remaining 800,000 is what is called the depreciable basis, the building value. And that now gets spread out over 27 and a half years because it's a residential rental. And that 27 and a half year equal deduction is great, because you're going to get 30 grand every year that will deduct from whatever income that property produced, and that 30,000 that gets deducted is money that went to your pocket, but you didn't have to pay taxes for. With cost segregation, we take a look into what you actually buy, and a lot of assets that come with that property depreciate much faster. So when you buy real estate, not everything that comes with that property should be depreciated over 27 and a half years. A multifamily property is going to have a lot of appliances inside, cabinets, countertops. There's crown molding, there's decorative items, there's hallways, there's laundry rooms sometimes. There's going to be common areas, grounds, landscape, sidewalks, parking lots. All those things depreciate in 5 or 15 years, not 27 and a half years. So our job is to come in, we reverse engineer that property, and we correctly identify everything that makes it up. We assign a value to that, and we identify what can then be bonus depreciated. So what is cost segregation? It's hard to explain because it's all this, but it's an IRS-approved application that will identify all of the components that you own. And by identifying them, you can now take that depreciation correctly. Those components are then assigned the cost depending on what they are. Once your CPA has that, you get to save money, and that's kind of where we come in. We identify the 5, the 7, and 15-year assets. You will still remain with a large portion that will be 27 and a half year. What is the 27 and a half year? That's going to be your roof. That's going to be your HVAC systems, your windows, your doors, your foundation. Those things will continue being depreciated over 27 and a half, and they have a cost. But everything else that we identify as 5 or 15 year, you get to depreciate faster. In this PowerPoint, you're looking at 7 years, but 7 years is an asset that we only identify really in office buildings because it's related more to office equipment. So what is bonus depreciation? Well, bonus depreciation is what we've been talking about, and it goes hand in hand with cost segregation, because the bonus depreciation is a rule that allows you to take almost all of it, if not all of it, a lot of it in the first year as a deduction. So everything that we identify that's 5 and 15, you can take 100% bonus depreciation if you've bought that property this year, or if you buy a property in the following years because of the big beautiful bill. We don't get you more depreciation. We're just getting it to you sooner. So that's a misconception that a lot of people don't understand. But what it does is that why are you going to wait 27 and a half years to take that same dollar when you can use that today? It's a front load of that depreciation. And the best way really is to run an estimate. So if you have a property, if you're interested in seeing what cost segregation can do for you, the best approach is to shoot me an email, send me the address. We can usually find most of the information and we can get you information on how this works.
So can I ask you a question?
You certainly can.
Go back. There you go. Right there. No, yeah. It says, no, yeah. We front load a huge portion of the depreciation in the first years of ownership when those deductions are most valuable. Why are they most valuable in the first years of ownership?
It's really the time value of money. So it's the same dollar if you take it 20 years from now or if you take it today. And with inflation and the dollar being eroded, that's somewhat of where that comes in. But again, sometimes it's not, and you don't have to do the cost segregation in the first year when you purchase it. A lot of times in the first year when you purchase a property, you don't have that property cash flowing. You don't really have that income to offset. So then it's really worthless to spend money on a cost segregation study if you don't really have that benefit. But in future years, say 5, 6, 7, 10 years into the property, you can still do a cost segregation, and whatever benefit you could have taken in that first year is then applied to that current year that you do that cost segregation. You're never allowed to go back and amend the prior return, so it's applied to that current year moving forward, and it's an automatic IRS-approved application. Once we go into the property and we study these properties, inside these properties, there's going to be a lot of what we call 5-year assets. So interior doors, decorative items, like I said, all the appliances that come in a multifamily, cabinets and countertops, all those things depreciate in 5 years. On assets like that, because of the new tax law and the big beautiful bill, you can either take the entirety in that first year as 100% bonus depreciation, or you could spread it over 5 years, which is still a better deal than taking it over 27 and a half years. Office equipment and office furniture would be 7 years. 15 years would be pretty much everything that's outside, except for solar panels, exterior lighting, and surveillance systems. Everything that's outside, all the drainage systems and sidewalks and landscaping, even some palm trees and royal palms and things like that will add value in a cost segregation study because we're allowed to apply a cost to that, and that would be a 15-year asset. And everything that depreciates in less than 20 years, according to the legislation, you can choose to either claim in the entirety as 100% bonus depreciation or to spread it over the 5 and 15 years, which would still be better than that 27 and a half. And again, like I said, there will still be a large portion of that building that remains in the foundation, the roofs, elevators, exterior windows, and things of those sorts. Couple examples, and I'm going to show you several assets because all assets, any investment property qualifies. Let's start with a small duplex here. After land was taken out of the purchase price, there was about $694,000 in building cost. And once that cost segregation was applied, they had about $161,000 in additional deduction on top of the $11,000 that they would have had back in 21 when it was straight line depreciation. Small Airbnb condo. We have done small properties, a small $70,000 homes in central Alabama. But like I said, any property will qualify. A $240,000 condo where the exterior isn't really included. This is just the interior. It's what we call a drywall-in study, because in a condominium, you usually don't own the exterior assets. They're owned through the association indirectly. So they got an additional $70,000 there in deductions for a $2,200 fee. More expensive single-family rental home. They got an additional $500,000, $1.8 million for a $6,000 fee. Triple net buildings like a Walgreens, $5,000 fee, got them an additional $380,000 in deductions. And lastly, a reasonably sized multifamily. This one is actually an actual study that occurred in Miami, and I believe there was 78 units in this multifamily complex, and $17 million was the basis after land was excluded. And the clients got 5.8 million almost in deductions for an $18,000 fee. These were multiple buildings and multiple units that had different finishings inside. It had been built, I believe, in the 50s, and so it required us a lot more work. But in newer multifamily units, usually those apartment buildings are the same. Those buildings are identical, and these studies can cost as low as $4,000 to $5,000, even though you'd be looking at 70, 80 units, like something like this. And then again, what qualifies for cost segregation is pretty much any residential rental or commercial property in the United States, sometimes even abroad. We have done studies on properties abroad. If the taxpayer can depreciate it and is an American taxpayer, it does occur. As long as you bought it in the last 15 years, the benefits that you could have taken then are applied to the current tax year. And they're usually substantial because you would still have another 15 years left in depreciation that hadn't been taken.
Can I ask
And
you a quick
that's,
question? Can I ask you a quick
yes.
question? It says, why does it have to be purchased in the last 15 years?
Well, if you've owned it for over 20 years, then the majority of it has already been depreciated over the regular straight line depreciation.
Okay.
So within 15 years, there's still half of it that hasn't been depreciated. And of that half, there's a good 30% of that that could have been 5 and 15 year and already fully depreciated. So we do what is called a catch-up look-back study, and that's then applied to that current tax year.
So, for example, that property I have in Studio City, they built it in '78.
Mhm.
So they've already used all the depreciation up, right? It's been more than 27 and a half years.
And there's also a cutoff date. When the IRS finally lost that court case back in 1997 that established cost segregation as being the correct method, and they turned around and they published the audit techniques guideline for cost segregation, and it became the thing. The cutoff date, I believe, was 1987, which coincides with when the passive income limitations came through. So properties have to have been bought after that to qualify for the cost segregation study. But it would be fully depreciated, and there would probably be improvements. So those improvements, let's say he put in $1 million 10 years ago, that would certainly give him substantial benefits that then get applied to the current year.
Oh, really? So they can kind of look back and look at all their capital improvements and their maintenance
Yeah,
and repairs and stuff.
exactly. And then there's a lot of benefits that stem from those cost segregation studies. Sometimes we can go into their depreciation schedule and identify things that were capitalized, like improvements of the parking lot, and we can reverse that. And what that happens is we take that out of the depreciation schedule, reduces the basis, so they're going to pay less recapture in the future. Slightly higher capital gains, but capital gains is 20% and recapture is 25. So they get a little arbitrage win there, but at the same time, we're allowed to expense that. And by expensing that, it gets deducted, written off, and you have no tax consequence in the future. And that can be an amazing thing. It comes from the tangible property regulations. But yeah, if you've owned the property, we can go and look at the depreciation schedule, identify opportunities. And essentially, the way we look at this is we're here to answer questions. So whenever you need to buy, whenever you want to renovate, or even when you're going to sell, give us a call because
So,
there's a
for
lot of
example,
tips and tricks.
the that 14-unit building that's already fully depreciated, if they did a cost segregation study, since they're selling the property, they could just hand that off to the buyer, and the buyer would be able to have that new cost segregation, correct?
That's true, but it would have to be adjusted to what the buyer's basis would be. So, but it's something that has been used as a negotiation tactic where the seller and the buyer are kind of like on a standstill. So the seller will pay for that cost segregation study and the buyer is happy. It certainly helps with the mortgage bank underwriting the deal once they see the available cash flow
Oh,
by
really?
doing a cost segregation on that property.
So they can probably get more leverage, huh?
Sometimes, yes.
So the banks will look at that. The underwriters, a commercial loan underwriter will look at the cost segregation study and determine how much they'll be able to write off on depreciation every year.
I'm sure some banks will have different requirements and depending on the underwriter, but we've had mortgage brokers come to us to get deals across the finish line and request these estimates. And what I'm not an expert in the finance industry of commercial property, but what I was told is that what really matters is the cash flow of the property.
Yeah,
And once you can show that that property is going to be cash flowing well, especially with the cost segregation study, making a lot of available money by not having any taxes,
got it.
it
Okay,
will be something that might help depending on the situation.
got it. Okay.
So, but that's kind of what we're here for. So if you're looking to buy, let us know and we can run estimates on your proposed purchases. Same thing when you're going to sell. If you have an impact with depreciation recapture, we can come in and assist. There's multiple strategies and ways to minimize. Because the only really way to avoid it is to 1031 exchange and then leave it to your heirs.
Right.
Otherwise, the IRS is always going to want to get that money back. But there's a lot of strategies to minimize that and avoid that happening.
Got it. All right, keep going.
Yeah, so simple as that. Why CSSI? We are the leading provider in the country, and we've been around for over 20 years, done over 60,000 studies, and we provide that ongoing free consulting whenever you need to buy, sell, or renovate. And now I give it back to you, Derek, because I know you have some questions, and I'm happy to answer that. Let me stop the share here.
All right. So, who's the ideal candidate for a cost segregation study? Like, what's the sweet spot?
So, in order to benefit from the cost segregation, you got to have income to be offset by it. And it's really a personal decision on how you want to use it, because again, it's a tax strategy. The best use of the cost segregation is for the high tax brackets. So you don't really want to wipe out your entire income. You can, and some people do that. But when wipe out your entire income and you're below the $100,000 income, now you're looking at 10% tax brackets, and it's somewhat of a waste of that cost segregation. But cost segregation is great on anything above 20%. So say you sell a property and you're looking at capital gains at 20%. You didn't do a 1031 exchange. It's a bill you're going to have to pay. As long as you buy a property in that same year, or if you own other properties, a cost segregation study on those is going to minimize or offset the capital gains that you're looking to pay. So that's a great candidate there.
Oh,
And then if
so
you have,
let me so let's say you're selling a building and you're gonna have a couple 100,000 in capital gains taxes. If you do some cost segregation on some other properties, you will be able to offset the capital gains taxes.
exactly, the capital gains and the recapture taxes on those properties that you sold. And that has no limitations. So anybody can use that to their benefit. The limitations are for the high income earners, unfortunately. High income earners that have active businesses or high W-2 wages, they have limitations on the use of these passive losses. They can only use the depreciation losses to offset rental income or business income they have from a business that they're not actively involved.
So you're
So
saying high earners that are W-2.
yes, or business owners
Oh, business.
that are not in the real estate industry or not in the real estate business. So that's why usually one of the spouses has a real estate license, or the spouse is actually actively involved in these properties, is dealing with the day-to-day, with the management, with the leasing, with the headaches, renovations. But developers, contractors, real estate brokers, property managers, those, because they're in a real property trade or business, their actual business counts towards them, and the passive losses from depreciation can then be used as active losses. And active losses can be used to wipe out everything. So it'll
What
wipe
do you mean
out
everything?
their
What do you
and
mean
their
wipe out
spouse's
everything?
so during their spouse's active income, so W-2 wages and business income gets wiped out, and even portfolio income can be wiped out.
Hmm. Wow. Um,
And
so
again, it's really a matter of every person has their own tax situation. A lot of times we're dealing with partnerships, and each partner is going to have a different advantage from the cost segregation. But it's usually going to be an advantage if they have the income to offset it. Say you're a high income earner and you own one rental property, but that rental property is giving you $200,000 a year. Well, you're paying 37% federal income tax on that 300,000 a year. By doing cost segregation, you wipe that out probably for 2 to 3 years on a property of that size if it's cash flowing like that. So you have 2 to 3 years of tax-free cash flow. That's where the benefit comes.
mhm. And can you talk about the new 2025 tax law, which says, can you explain the 100% bonus depreciation rules? Because I'm still having a little trouble understanding that.
Yeah, and it is a tough one to explain, but it's the rage right now. So 100% bonus depreciation came about in 2017 for the first time. Prior to 2017, there was no bonus depreciation on a used asset. So if you bought a building and you did a cost segregation study, you would take 5-year property in 5 years, 15-year in 15 years, and you remain with 27.5-year property. What bonus depreciation did, it was a law in the Tax Cut and Jobs Act that said every asset that depreciates in less than 20 years is subject to 100% bonus depreciation. And that's why a lot of people went crazy buying vehicles for their businesses, because a vehicle is a 15-year asset, 20-year asset, and it gets 100% bonus depreciation. It's a way to get that deduction at the end of the year so you can reduce your income tax. And in real estate, 5-year assets inside, 15-year assets outside usually amounts to about 30% of a multifamily property. So $1 million multifamily can have anywhere from $200,000 to $300,000 in 5 and 15-year assets.
So they can, okay, so 100%
Yeah.
means that year that they do the cost seg, they can depreciate 100% of the depreciation they can use 100% of that depreciation amount,
So,
$200,000.
a multifamily is going to have about 30% in 5 and 15-year assets. 70% is going to remain in 27.5-year assets. Well, that 30% of 5 and 15, you can claim the entirety, 100% bonus depreciation. You don't have to take it over 5 and 15 years.
But can you take
And
it over 5 or 15 years?
you can.
Because I
You
mean,
can elect
depending how
out. You
much,
can elect out of bonus depreciation.
okay. Can you skip a year and then take it the next year or what?
No. So depreciation has to be used as it's available. And sometimes people do elect out of it because it's too much depreciation. But if you don't use all the depreciation in one year, it gets carried forward until you use it up.
Okay, yeah,
So
that's what I mean. Because it's depending
yeah.
on, you may not need 100%. If you've only owned the building for 1 or 2 years, you may not have enough cash flow to make it worth using 100% depreciation, right?
So what you don't use this year moves forward to the next year,
Okay.
and it gets carried forward until you use up all those losses.
But some of that depreciation can go to shelter some of your other income?
Depending on the person's tax how can I say possibilities, depending if they qualify as a real estate professional status and things like that of the sort.
Okay.
But the way it works is that it happens first in the entity. So that entity is going to have its own income, it's going to have expenses, and then on top of that, you're going to have this huge depreciation loss, which is going to put that entity that holds that asset into a loss. If it's a pass through, it goes directly to the taxpayer. If it's a partnership, it's going to go through a K1, which in this case would be negative. And at their personal tax return level, that's where it's going to settle with other rental income they have, W-2 wages if they can use that, or even portfolio income that they might have from stock gain, cryptocurrency, things like that.
So, and you do free estimates. I mean, I got one for that property in Studio City. So talk about that.
Yeah. So that's any good engineering, cost segregation engineering company should be able to do that. We have an entire team. That's all they do is run these preliminary estimates, and they'll take a look at your property, find information that's available online. There's so much nowadays, pictures from when it was listed and things like that. And they'll run it through our database and get you an idea of what the high and the low end would be of the benefit that you would be entitled to. And that's also when they give you a fee of how much that cost segregation study is going to cost, because that fee is going to vary slightly depending on size and complexity of the project, how
Yeah.
much time they're going to spend on it and things like that.
Great, great. So let's talk about CPAs and working with your CPA because that's an important component of making this thing work.
So CPAs are great. They have a lot of knowledge, but unfortunately, a lot of them don't have deep knowledge in real estate accounting, even though they have clients that own a ton of real estate. So we're constantly doing continuing education for CPAs, and I'd say over the past 3 years, especially with the new tax bill, they're more on board and they're not stuck to misconceptions that they had in the past. They used to think that these projects were only applicable to properties that were $10 million and up, that these fees were in the $20,000 to $30,000, which isn't the case anymore. Now we do properties as small as $60,000, as long as there's a benefit for the client. And they were scared of the IRS coming back and auditing clients that had done cost segregation, because cost segregation only really came about in 2003. So they were scared about audits, but history has proven that this is a very, very low audit rate. We've done over 65,000 studies and we've had about 27 audits that we've been involved in. All those audits were successful and none of them were triggered by the cost segregation. It's usually something like the payroll or the real estate status for doctors and attorneys that are trying to claim that without being able to. But in regards to the cost segregation study, we'll come in and we'll defend those studies at no cost for our clients. We're so confident with those results.
That's amazing. So, again, talking about sellers. So I would imagine this is a kind of a nice little bonus if somebody's selling their building that they do a cost segregation so that the buyer can take advantage of that depreciation, right?
Yep, if the buyer is on board and if the buyer can take it. So the best really way for the seller is just to offer an estimate and let the prospective buyers know that they could be entitled to that. And because cost segregation has grown so much in the media, it's becoming more and more common, and they'll probably already know about it. They've already been doing it, or if they haven't, they'll look into it. But it's certainly something that entices.
Yeah. So I mean, it seems like all of a sudden I hear about cost segregation everywhere, and I guess with the new tax bill, it really turbocharges the benefits of the cost segregation.
Yeah, like I said, it's only been around for 23 years, and I'd say in the last 3 to 4 years, the CPA community is finally on board. But I'd still run into real estate investors, really big real estate investors that have been around for 30, 40 years, have hundreds of millions of dollars of properties and never heard of this because they're using their same CPA from 30 years ago, and those CPAs are really good. They're not really focusing on these new opportunities that are available out there. But
Well,
but but our goal is to talk to the CPAs and hold their hands if necessary. We help them during the application. In actuality, we work for them because they're the ones preparing the tax return, and we want them on board. We want them participating because we will follow their instructions.
right, right, right. Yeah, no, this is big. I'm really looking forward to getting this information out to my apartment, owners that I work with and that I communicate with, and I think it's going to be a great thing for a lot of these people. But let's see. Let me see if there's. Oh, how long does it usually take to do a study, a cost seg study?
That's a great question. It used to take a couple months and it was very painful, especially if you're waiting for those for your tax return. But with technology, our turnaround time is about 3 weeks now. Once we get the site survey completed, we do have to go to the property, take pictures inside and out. They're essentially the eyes on the ground for our engineers. And once we collect all the data, information, surveys, appraisals, inspection reports, whatever you have, cost details of any improvements, renovations that you're doing, blueprints, floor plans, all that goes back to our engineering team. And then from there, it's about 3 weeks and it gets delivered.
Can you expound again on owners that have done a lot of repairs and a lot of upgrades on their buildings? Is it called PAD or something like that?
Yeah. So partial asset disposition, the PAD, is a fantastic opportunity and it stems out of the cost segregation report because the cost segregation is going to break down the entire cost of your property. So you're going to have now a cost for your roof, and that roof gets depreciated over 27 and a half years. But 2 years down the line, now you got to replace that roof because it was already 30 years old. And by replacing that roof, you still had about 25 years of that cost of that roof left to depreciate. So what the partial asset disposition does is we can come in and calculate the cost of that roof that remained, how much was thrown into the dumpster, the cost of removal, which usually gets capitalized because you pay contractors to put in a new roof. They come in, they put in a new roof, that entire cost gets capitalized, but a portion of that was to remove, was to demolish that roof and throw it in the dumpster. So we calculate that, and with that number, that partial asset disposition number, you're allowed to go and expense that. And that's fantastic because, again, that's a direct deduction write-off, and you have no tax consequence recapture in the future. It's not depreciation.
So this is also another bonus that you can help people with is, especially if they spend a lot of money putting in new HVAC systems or upgrading the electrical or resurfacing their parking lots, or what about if they have to do you know any, well, you're not in Los Angeles or California, so I don't know if you know what soft story retrofit is in California. It's when the state or the city requires a owner to upgrade soft story component of their building, which is living space built over garages or parking spots. And
Yeah, I haven't heard of that.
okay, so yeah, there's a big
Hmm.
number there. It usually costs between 100 and I mean, 100 and 150,000 dollars to $200,000 that the city or the state requires them to do, and they've
And
given
it's
them
and
like,
it's their financial responsibility, or does insurance, does anybody
no,
help
it's
with
the
that or no?
seller. It's a burden on the seller because of the
Yeah.
earthquake in Northridge earthquake in
Yeah.
'94. Now they
Sure.
are requiring if you have living space built over a carport, for example.
Hmm.
Usually the posts that are there are not earthquake sufficient. So now they've
Yeah.
required anybody with, I think, 3 units or 4 units and above. I can't remember. Yeah, 4 units above has to reinforce. They call it soft story retrofit, but that's a big number. So a lot of these people literally spend 100, 150, $200,000 out of their pocket for that.
Yeah.
So
So something like that, we can certainly come in, and if they already have a cost segregation report, then that's a very, very cheap fee. I'd say $500 to $700 to run calculations that they're going to be able to expense a good amount there, at least 50 grand.
okay, so
It
if,
really
if they
depends.
if they spend $150,000 on in 2024 to do it, do they expense that on the whole thing on their tax return?
So the expensing from the partial asset disposition is what's being taken out, thrown out. What they're adding in has to be capitalized, and then that's a new report for their moving forward.
Okay.
So we'd have to look at the project and have an idea of what's being done and the cost in order to give that idea. But essentially what it is, there's a lot of things that stem out of that cost segregation report. And again, we're here to provide this free consulting. I had a prospect the other day send me a couple car washes that he just acquired, and he wanted to know the fee for those. But car washes is a special asset that the IRS allows to be fully depreciated in 15 years. So essentially, his CPA can claim 100% bonus for him without us even having to do a cost segregation study.
Oh, wow.
So that's kind of where we go. And I actually had the calculations run for him, so his CPA just has to apply it because there's nothing to break out. The entirety is a 15-year asset, excluding land.
What about like a
But
triple net
but
commercial
that's a
property?
particular case. I'm sorry?
What I'm sorry, let me interrupt you. What about like a triple net commercial property, like a Burger King on a pad or something?
Yeah, so those are great also because the building owner might not own the equipment and then the TI for Burger King, but he owns the building, the electrical, the plumbing, so there's some benefit there. And then there's an amazing parking lot. And that parking lot there has an amazing cost that gets to be 15-year and fully bonus depreciated.
So in other words, like in 15 years, they're going to say you have to re-asphalt it or whatever.
So $1 million Burger King is usually bringing about $380,000
Mhm.
in depreciation first year.
Oh, wow. I don't know of any million
It's
dollar
it's
Burger Kings. They're all like a 2.5 and up, I think. But yeah, I get you. I get you.
but
Can
but
I
but remember, I'm excluding land, and sometimes land can be pretty heavy, 50, 60, 70%.
hey, can I share my screen and show the audience the estimate you did for that 14 unit building?
Sure.
Okay. So this is the property I have in escrow right now in Studio City, and it's 14 units, built in 78. Really nice property, and I'm going to show you the cost segregation study you did. Hold on one second. If I can find it. Oh, here we go. All right. Okay, so you guys did a complimentary analysis for the property, 14 units. Can you see it okay?
Yeah, I certainly can, and I'll go over it. So essentially, what we did is we took a look at the property, and if this sells at 4.99, and there are no 1031 exchanges involved in the purchase, what we looked at is that the county appraiser allocates only 17% to land value. So we took out 17% of that 4.999 sale price, and we end up with a building cost of 4.149. So that's what a CPA would get, and then spread it over 27 and a half years. But by doing a cost segregation study, we're expecting that on our low end, which is kind of low here, we're going to identify about 16%, 13% in 5-year assets, and 3% in exterior 15-year assets that we're going to be able to 100% bonus depreciate. And that's going to get you about 662,000 on our low end projection of a first year deduction on a property like this. Our higher end projection, you're looking at about 905,000 on a property similar to this, which is most likely what we're going to find here. The fee for something like this would be $6,350, which is a business expense, and that's all inclusive. So there's no surprise charges, no additional fees. It includes our site survey visit and things of the sort.
Got it. Wow. And then you have some more information. I know it's the type is too small. It's really hard to see. I know people watching this, but
No problem at all. But essentially, when we send out these estimates that have that summary chart right there with those pie charts, we also give you some projections that shows you what your property would look like if you were to depreciate it over 27 and a half years with and without cost segregation. So by buying this in December, you're only going to have a prorated amount for the 27 and a half years if you didn't do cost seg. But you're essentially going to have about $150,000 a year in depreciation without doing cost segregation study. But if you did do a cost segregation study, you're going to have about $610,000 in depreciation this year. And then in the following years after that, for the entirety of your ownership, you're going to have 128,000. So we do reduce a little bit your future depreciation in order for you to get that big chunk in the first year. So instead of 150,000 a year in the subsequent years, you're going to get about 130,000 in depreciation left.
still pretty good.
It's all about you being able to use that money. If it's something that's going to be beneficial to you, it's somewhat of an easy decision. Something to be aware of, though, is that you usually want to do these on properties that you have a longer term hold horizon. You don't want to do it on property that you're flipping. Doesn't mean that you can't do it. It's just that whatever benefit the IRS gives you when you sell that property, they're going to want it back via recapture. But if your exit strategy is to 1031 exchange into something else, then no problem at all. That gets sheltered and carried forward. If you leave it for your heirs through inheritance, they will receive it on a step-up basis, free and clear of recapture taxes, and they get to do a cost segregation all over again. So there's a couple of things that are interesting.
So it sounds to me like the strategy for a seller would be to get the free estimate up front and then tell the buyer, I will do a cost segregation for you once we have a sales price, because you need an accurate sales price, right?
Yeah, so we need to know what their basis will be in order to do it. Yeah.
So if somebody's got a $5 million building and you get the estimate at 5 million, but you end up selling it for 4.75 million, you're going to do the actual real analysis at 4.75 million and then hand that off to the buyer.
Exactly, because sometimes they might be bringing in 1031 funds, and the 1031 funds, what it does is it reduces the basis. So as a simple example, let's say they sold a property and they're carrying $42 million in capital gains. That $5 million property, now we only have $3 million to work with. And out of that $3
Oh,
million, we got to allocate land. So what that 1031 exchange sheltered capital gains does is that it reduces the basis in the new property. But it's still worthwhile looking into it as long as you're buying upwards.
as long as you're
So
what?
you're buying up in a 1031 exchange.
Okay.
You're buying a more valuable property.
You mean the
You're
seller
buying a
or
more valuable.
you mean the seller?
The buyer, the 1031. In a 1031 exchange, as long as you're buying a bigger property, more expensive,
Yeah.
cost segregation will be worth it. If you're just sheltering the exact amount that you sold, there usually won't be any benefit.
Got it. Okay. So so I have a building. So I guess we have a potential deal on this property where they're going to put down, I think they're putting down 2.5 million. Uh, and so the cost basis on this property would only be, if it was sold for 5 million, 2.5 million as well. Less the land, right?
Yeah, you got to take out the land.
So
So
2.5 million minus 17%, that's their basis. So they'd be getting
that
a
should
lot
be their
less, so
basis.
they'd be getting a lot less depreciation.
Again, the only way for us to really know is have their CPAs run that calculation. That's why I want to have them on board.
Right.
And I'm giving these numbers and things here, but ultimately it will be the owner and the CPA who decide.
Yeah.
So we go by the county appraiser just because it's conservative. In this particular case, this property is a great candidate because land value is favorable. Sometimes we'll run into properties that land value is 60, 70%, and that really hurts us. So you have to find alternative methods of evaluating that land, an appraisal, a comparable land sale, a broker's price opinion, an insurance
Maybe
policy.
maybe you got a huge commercial lot worth millions of dollars, but you got one little tiny structure on it that's, not worth anything.
Yeah.
Got it.
And some a lot of properties are sold for land value only, so then there's not much left. In a ground lease situation, you just own the ground. The building is owned by the tenant. Once that lease is up, then it reverts back to the owner, and then he can do a cost segregation. If you own a commercial space and a tenant leaves, whatever they leave behind, you can do a cost seg on and then partial asset dispose of it.
Great, great. Well, this has been quite informative, and like I said, I can't wait to share this information on YouTube and send it out to my various apartment owner clients. I think you'll get a lot of people raising their hands for a complimentary analysis, which is amazing. And why don't you tell them how I'm going to have all your information below, but tell them again how to reach you.
Yeah, so the email is best. Just shoot me an email. If you have any questions, I will get those answered pretty quickly. And if you want an estimate for a property that you've owned for a couple of years, usually the depreciation schedule is best so we can get this an accurate number so you and your CPA can review. And if it's a property that you just bought this year and you haven't even sent it to your CPA yet, all we need is the closing statement, and that would be sufficient. With the information we have, we'll get you that idea and a fee. And it's as simple as that.
Great.
And once you have
So, I
that in your
mean,
hand, it's like a roadmap. You can follow and strategize and discuss. So we're happy to help.
it seems like a super easy process. It doesn't take that long. And I think the fees that you guys charge is very reasonable for the benefits that the client gets by using a cost segregation.
It's cheaper than appraisal a lot of times, and the effect is a lot more substantial because if that loan doesn't go through, you got to get a new appraisal.
Yeah,
So
got it. Well, Saul, thank you so much. We really appreciate your sharing your expertise with the audience here. I know there's a lot of people that are going to be raising their hands and wanting to talk to you. So I'll have all your information below, your contact, your phone, email, everything like that, website for your company, and look forward to working with you in the future with my clients.
awesome. Well, I appreciate the invitation and the opportunity to come here and speak with you and your viewers. So I appreciate it.
Got it. All right, everybody.
Have a great one.
Thanks for watching. This is Derek Ruiz with Saul Murray, and we look forward to talking to you soon. If you have any questions, reach out to me. We're here to help and help hopefully make your life easier and get you to save some money on taxes. All right, everybody. Talk to you soon. Bye-bye.